Hello and welcome. Today, we're getting to grips with a topic that can easily trip up even the savviest savers out there, your UK pension allowances. Getting these rules wrong can lead to some pretty nasty, unexpected tax bills, so let's make sure you're fully prepared. So let me just ask you this straight out. Could your pension savings, the money you're carefully putting away for the future, actually land you with a surprise tax bill this year? It's a real risk, and honestly, understanding the limits is your absolute best line of defense. Now, to help us navigate this, all of the insights we're covering today have been put together by the specialists at the fantastic UK accounting firm, My Tax Accountant. These guys live and breathe this stuff day in, day out, so you know you're in very good hands. Okay, let's dive right in. Here's what we've got on the cards. We'll kick off with the standard pension limit. Then we'll get into the nitty-gritty of the taper rule for high earners. We're going to walk through a real-world example, look at some smart planning tools, see what the 2025 budget means for all this, and then wrap it all up so you know exactly what to do next. Right, first things first. Let's talk about the foundation of all of this, your pension's annual limit. This is the standard rule that applies to most of us saving for retirement here in the UK. So, for the 2025/26 tax year, the standard annual allowance is a pretty generous £60,000. Now, the crucial thing to remember is, this isn't just what you pay in. It's the grand total from all sources. That means your contributions, anything your employer chips in, and even money from a third party. For a lot of people, this is the only number you'll ever need. But if you're a high earner, this is really just the beginning of the story. That's not all, and here's where a lot of people go wrong. We have to talk about the tapered annual allowance. Honestly, you should think of this as a potential trap for high earners, one that can dramatically shrink how much you can save tax-free. And this quote here sums it up perfectly. It's a targeted mechanism. It isn't for everyone. The taper only actually kicks in if your income crosses two very specific thresholds in the same year. You have to clear both hurdles for your allowance to get smaller, which is why understanding exactly what these thresholds are is absolutely vital. So, here are the two crucial income tests. On the left, we have threshold income. That's basically all your taxable income minus what you personally pay into your pension. But on the right, you've got adjusted income. This is your total taxable income plus all the contributions your employer makes. You see the difference? Adjusted income gives the full picture of your earnings and your total pension savings combined. And here are the magic numbers for the 2025/26 tax year. For that taper to hit you, your threshold income has to be over £200,000 and your adjusted income must be over £260,000. If you're under just one of those, you're fine. You keep your full £60,000 allowance. But if you're over both, well, that's when your allowance starts to shrink. Let's move to a practical example, because seeing the numbers in action just makes it all click into place, doesn't it? We're going to crack the taper code with a real-world scenario. So let's meet Annika. She's a successful freelance consultant based in London. We already know her threshold income is over that £200,000 mark. And when we add in everything else, her adjusted income for the year comes to £314,352. So yep, she's over both limits. Her allowance is definitely going to be tapered. The question is, by how much? Okay. Here's how the maths works. It's actually pretty simple. For every £2 of adjusted income she has over that $260,000 limit, her annual allowance goes down by £1. So first, we see she's £54,352 over the limit. Then we just have that number, which gives us the reduction amount $27,176. Finally, we take that away from the standard $60,000, and there we have it. Annika's personal tapered annual allowance for the year is £32,824. It's also worth knowing this tapering can go all the way down to a minimum allowance of just £10,000 for the very highest earners. Now, stay with me. The next point might surprise you. Just because your allowance might be smaller doesn't mean you're out of options. There are some really smart, strategic tools you can use. We're going to look at carry forward and then a really critical rule called the money purchase annual allowance, which can trip you up badly if you're not careful. So, this is the carry forward rule. It's fantastic. It lets you look back at the last 3 tax years and use up any allowance you didn't use then. So that's 2022-23, 23-24, and 24-25. The key rule here is that you have to use up this year's allowance first, and then you draw from the oldest year, which is 22-23. And don't forget, the allowance used to be lower. It was just £40,000 back then. So you have to base your calculations on the specific limit for each year. Okay, now for a huge red flag. This is the money purchase annual allowance, or the MPAA. This applies to the most common type of pension, a defined contribution one, where you have your own pot of money. If you decide to flexibly access that pot and take any taxable income from it, not just the tax-free bit, you trigger this rule. The second you do that, your future allowance for saving into that kind of pension plummets to just £10,000 a year, permanently.
And here is a pro tip you absolutely cannot afford to forget. Once that MPA is triggered, the carry forward rule we just talked about, it's basically useless for those pension pots. You absolutely cannot use leftover allowance from previous years to go over that £10,000 MPAA limit. It is a hard, unchangeable cap on what you can save in the future.
Right. As you know, pension rules are always evolving. So let's take a quick look at a really important change that was announced in the 2025 budget, which is going to affect high earners. So right now, salary sacrifice is an incredibly tax-efficient way to boost your pension because you save on both income tax and national insurance. But the 2025 budget has put a date on a big change. From April 2029, that national insurance exemption will be capped at £2,000 a year. The income tax benefits will still be there, but this cap will definitely make it a bit less attractive for people making large contributions. So it's something you really need to factor into your long-term planning. Okay, wow, we have covered a lot of ground. So let's pull all of this together and really focus on the key takeaways and the practical next steps you should be thinking about. So to recap the absolute must-knows. 1. Know the standard £60,000 limit. 2. Do your homework and check if your income triggers that taper. 3. Make smart use of carry forward. 4. Be incredibly careful with that £10,000 MPAA. And 5, remember that if you go over your limit, you will face a tax charge. If that happens, it's worth asking your pension provider about something called scheme pays. It might be a good way to handle the bill. Now, this is really, really important. The information we've gone through today is for general guidance. Everyone's financial situation is different, and as you can see, these rules can get pretty complicated. So you shouldn't rely on this information alone when making big financial decisions. Which brings us to the final and most important question for you to think about. After everything we've talked about, are you truly confident that you're making the most of your pension allowances without accidentally wandering into a tax trap? If you have even the slightest bit of doubt, the smartest thing you can do is talk to an expert. For professional, tailored advice on your pension and your taxes, you really should get in touch with the specialists at My Tax Accountant. You can call them on 020-857-8531, or you can drop them an email at info@mytaxaccountant.co.uk. Thanks so much for your time.